Imagine you discovered an extra $10,000, not for immediate spending, but purely for investment. What if you allocated that sum into two of today's most popular ETFs, VOO and SCHD? Could this modest amount become a significant wealth-building engine over time? Let's uncover the potential journey of that $10,000. We'll dive deep into a hypothetical scenario, revealing just how powerful these investment vehicles can be, potentially shifting your entire perspective on long-term growth and financial independence. Let's begin with VOO, the Vanguard S&P 500 ETF. When you invest in VOO, you're essentially buying a tiny piece of 500 of the largest U.S. companies. Think Apple, Microsoft, Amazon, Google, all rolled into one easily tradable package. VOO's primary goal is simple: to track the performance of the S&P 500 index. If the S&P 500 goes up, VOO generally follows suit. Its key advantage lies in broad diversification, instantly spreading risk across many industries and companies, reducing the impact of any single company's poor performance. Furthermore, VOO boasts an incredibly low expense ratio, meaning more of your money actively works for you. This ETF is a cornerstone for long-term growth-oriented investors due to its consistent historical performance mirroring the broader U.S. stock market. It's a set-it-and-forget-it type of investment for many, aiming for capital appreciation, reflecting the overall health of the American economy. Investing in VOO truly means betting on the enduring strength of largest U.S. corporations, a strategy historically rewarding patient investors. Now, let's turn our attention to SCHD, the Schwab U.S. Dividend Equity ETF. SCHD takes a different approach, focusing specifically on high-quality, dividend-paying U.S. companies. While VOO aims for broad market exposure, SCHD meticulously selects companies with a track record of consistent, growing dividend payments and strong financial fundamentals. It's about sustainable dividends. This means companies within SCHD are typically mature, financially stable businesses that regularly return profits to shareholders. For many investors, SCHD appeals primarily for its income-generating potential. Dividends received can be passive income or reinvested to compound returns. This reinvestment strategy is incredibly powerful, allowing dividends to buy more shares, generating even more dividends. SCHD is often favored by investors seeking a valuable blend of income and growth, particularly those nearing or in retirement, who appreciate regular cash flow. It offers a defensive quality during market downturns, as dividend-paying stocks tend to be more stable. Let's bring our $10,000 into play, first with VOO. Imagine investing that sum precisely 10 years ago, at the start of 2014. The S&P 500 has seen impressive growth over the past decade. While past performance isn't a guarantee, it provides a valuable historical benchmark. A $10,000 investment in VOO in early 2014, with all dividends reinvested, would have grown significantly. The S&P 500's average annual return over the last 10 years typically ranges 12 to 14%. Using a conservative 12% for our scenario, compounding annually, your initial $10,000 would approximate $31,058 after 10 years. That's a substantial increase, more than tripling initial capital. This growth is primarily driven by capital appreciation, the increase in underlying company share prices. VOO's strength captures the overall upward trajectory of the robust U.S. stock market, providing solid returns for patient, long-term investors focused on wealth accumulation. Now, let's see how our $10,000 would fare if solely invested in SCHD over the same 10-year period, from early 2014. SCHD's total return, including reinvested dividends, has also been very strong. Over the last decade, SCHD achieved an average annual total return often comparable to and sometimes even surpassing the broader market, largely due to its focus on high-quality dividend payers and the incredible power of dividend reinvestment. Applying an average annual return of, say, 11 to 13% for SCHD, your $10,000 would grow considerably. Taking a conservative 11.5% average, your $10,000 investment in SCHD would approximate $29,865 after 10 years. That's substantial growth, while potentially slightly less than VOO in this specific scenario. SCHD offers a key distinction, a consistent income stream. Even if the share price fluctuates, dividends keep rolling in, providing a psychological buffer during downturns and a tangible return. Reinvested dividends accelerate growth significantly, demonstrating powerful dividend compounding. So, which one is better? The truth is, VOO and SCHD aren't necessarily competing, but rather serving different, often complementary investment goals. VOO excels in broad market exposure and capital appreciation. It's ideal for investors primarily seeking aggressive, long-term growth, comfortable with market volatility, trusting in the overall expansion of the U.S. economy. SCHD, conversely, champions dividend income and provides enhanced stability, making it attractive for those prioritizing regular cash flow or a more defensive portfolio position. Its consistent dividend payments are particularly appealing during retirement stages. Many investors wisely choose to hold both. A common strategy allocates a portion to VOO for growth and another to SCHD for income and a smoother ride. For instance, a 50-50 split provides a balanced approach, capturing broad market growth while simultaneously benefiting from consistent dividends. Your personal financial goals, risk tolerance, and investment horizon should dictate which ETF or combination best suits you. Understanding VOO and SCHD's potential is crucial, but remember, every investment decision must align with your unique financial situation. Do you prioritize maximum capital growth over a long horizon, or is a steady income stream and a stable portfolio more important? Reflect on these differences. Consider how each ETF fits your grand financial strategy. If you're pondering which path to take or how to blend these powerful tools, your next step involves deeper personal research into your specific financial objectives. Educating yourself empowers informed choices for your individual wealth-building journey.